Good afternoon, everyone. Welcome to our webcast on short verticals. I'm Connie Hill. I'm happy that you have joined me here today as we meet each week at this same time to discuss short verticals. Now, I have a question for you. How many of you in trading short verticals, when the stock goes to your short leg, that short strike price, it starts to stress you out? You have distress. In my terms, I would say freaking out. But some of you that are a little bit younger, you might say crashing out. How many does that apply to? Has that ever happened to you? Well, today we're going to talk about something that I think might help you frame up that scenario and not be quite so stressed about it. All right. I am joined in the chat with Brent Moores. I'm happy Brent is here. Some of you have said he is running a marathon in the chat today, his third straight one. We appreciate Brent. As you know, he's very well qualified to help out and answer questions, 25 plus year veteran of the markets and good friend. So as you have questions, go ahead and post those. All right. I'll keep my eye on the chat. Brent will cover the things I can't quite get to so that you get your questions answered. And when you are listening to this on the recording, because I know there are lots of you that do, when you have a question, go ahead and put that in the comments section. I go back and review those throughout the week so that you get your questions answered pretty quickly as well. Well, I hope you're following me on X. I'm Connie Hill CS. Hope you're following Brent. He is Brent Moore CS, and we'll post educational content, things we notice about the market, little nuggets that we find interesting that we think you might like. We will post about it. So it's free, it's easy, follow along. Let's go through our disclosures and lay out our agenda here. Options carry a high level of risk and are not suitable for all investors. What we talk about is for information and education. Don't consider it a recommendation. We will be talking and using the paper money application. This is what you download to your computer. It's the most robust version of Thinkorswim. Investing involves risk, including the loss of principal. Something that's different in paper money than in your live account is that short options can be assigned early. Can be assigned at any time, regardless of the in-the-money amount. In your paper money account, it doesn't assign early. In your live account, boy, it sure can happen and does happen. So just know there's that difference with paper money. Past performance of any security or strategy does not guarantee future results or success. Now, I just want to bring to your attention a couple of events that are coming up. Actually, our Anaheim event is booked. Okay, so if you didn't register, sorry, Charlie, maybe look to go to Miami and New York. All right, we'll have two market drive events. Market drive events are a little bit different than the workshop in that it's more pertaining, not so much a curriculum per se, but analysis of what's going on in the markets where kind of near-term opportunities might be. And so it's a little bit more relevant as far as what's going on in the marketplace. So what some of those news stories are and how it might impact you as a trader. Now, I'm going to go over here to the chat real quick and see if any of you said, yeah, I can get a little stressed out when my short leg, when the price of the stock comes near my short leg. Looks like maybe a couple of you that is relevant to, but I believe that could be relevant to all of us. AOS, Myron says, what does AOS stand for? It's for our Advanced Options Strategies workshop. So those of you that maybe know some of the basic option strategies and are ready to maybe get into some multi-leg strategies, that's where the advanced options fits in. Okay, that's what it's for. We will do a few of those throughout the year, but not as many as our basic workshop that has technical analysis and option strategies. Yeah. All right. I'd never eat here says, yes, I'd get stressed. All right. We're going to talk about that today. We're going to talk a little bit about some concepts that hopefully all of you feel comfortable with as far as short verticals. It might just be a little bit of a review for you, but I want those of you that are even new to be able to keep, be able to come along with us as far as our discussion goes. Throughout, we'll talk about trade management techniques, and we're going to be looking at a lot of examples. In fact, I have about 6 examples lined up. I don't think we're going to have time to get to all of them, but I'm going to try. Now, as far as short verticals go, some of you are like, I don't know. Today, we're going to focus on short put verticals. The market's a little bit more bullish than bearish. I think all the indices today are up about 0.5%. So they're kind of falling in line there as far as making higher highs and higher lows. And so for somebody that's bullish, they might consider doing what's called a short put vertical. The first thing you do is you sell an option. And when you sell that option, typically it's going to have a price associated with it. And then you're going to buy an option of the very same expiration date. So you have a short strike and a long strike. And the net of that comes in as a credit. And you receive that credit into your account immediately. Okay, that credit goes there. So it's kind of like getting paid at the beginning of the trade. So you want to kind of identify for that. And then what you want to know is that you sell the more expensive put and you buy the less expensive put. It's typically a bullish to neutral strategy. What are the benefits? Every strategy has some benefits. Every strategy has some potential risks or things you might want to be aware of. So selling short verticals can be a way that people create an income stream into their portfolio just by repeating that strategy. It can create a lower break-even point than buying the stock outright. Your gains are known right at the beginning, all right? They're limited to whatever that net credit is that you bring in. It's never, ever going to be higher as long as you have those two legs together. Now, if you separate them, work with them separately, that can be another story. But it is a shorter time frame type trade. Sometimes some people might do it a little bit longer. Maybe they might do it up to 60 days or 70 days, something like that. But most of the ones that we're going to look at, generally, we're going to buy or sell between 20 to 40 days worth of time. Sometimes that goes up to about 50, but that's in that shorter time frame. Now, are there any risks? Absolutely, there are always risks. Okay. The max risk is the difference between the strike prices minus the credit you received. And we're not counting any commissions or fees in there, okay? Those obviously you'd want to take into consideration as well. Options that short leg can be assigned at any time. It doesn't matter if it's in the money or out of the money. Yeah, it's more likely to happen if it's in the money and if we're closer to options expiration date. However, it could be shortly after you get into that trade and sell that short strike. That's why it's important that you look for liquidity. You want to make sure there's a lot of contracts being traded, not just a handful of contracts. That helps reduce your exposure to early assignment if there's a ton of contracts out there. And one thing to keep in mind, with these short verticals, typically we're risking more than what we have to gain. We're doing that because it's a higher probability trade. However, one max loss can wipe out several winning trades that you had. Okay, so want to be careful to try to not have a maximum loss if you can all handle that, right? Make that be the case so it doesn't wipe out a bunch of gains. All right, let's talk about one more thing, and that will be that we'll talk about probabilities, and probabilities are theoretical. They're not guaranteed. They're not set in stone. They are just probabilities and likelihoods that we'll be talking about. All right, we're going to head over to my Thinkorswim. And as we come over, I've got a quick look here at the SPX. And I did have some time in here. I'm going to just adjust this. I like to have about a month's worth of time in the future so we can see if there's any earnings dates. Of course, an index doesn't have earnings dates. But we can see overall the SPX, and this is true with the NDX, very similarly. It's creating a pattern of higher highs and higher lows. And so more likely than not, traders are going to favor a bullish short vertical instead of a bearish short vertical. Now, there could be an opportunity for you to do a bearish short vertical. It's just not likely that that's what you're going to be hunting for, right? You're going to be hunting for things that go away or go the same direction, I should say, as the overall trend of the market. All right. Just checking the chat here. Rexbird said, I'd never eat here. He gave you a late pass. That was nice of you to give him that late pass. All right. Let's look at a few examples here. Now, the examples that we're going to use here today came from the last time we spent some time together, which was about 3 weeks ago. We updated our watch list I have it sitting right here. We ran a couple of scans actually, to create the watch list. It involved stocks on the S&P 100 and the NASDAQ 100 with some additional filters. We did that on April 24th, and that's going to be our watch list for the next few weeks. And about maybe once a month, every 6 weeks, we'll update that watch list. Okay, but we've already determined we want to use these stocks. They have higher liquidity. The stocks have higher trading volume, which usually leads to having lots of open interest contracts. And that's what we want to be looking for. All right. Typically, that'll lead us to narrower spreads, meaning the difference between the bid and the ask is a little bit more narrow. Now, we're going to take a look at our first example here. This particular example, again, came from our list, and that is CrowdStrike. I will open up our watch list here for a moment so you just can see some of the stocks that are on there. I've got it sorted by a 1 month % return. So that's calculating what the 1 month return is for all the stocks on the watch list. This one that says 3 at the top, that's a 3-month performance. Some people might want to sort it by a little bit longer period of time. This one's pretty short. This is a 1 week time frame. All right, but I really was gauging it off the 1 month time frame. Now, I mentioned to you there might be something that could help you feel a little bit more comfortable when your short strike, the stock goes and touches it or exceeds it. All right. Now we're looking at CrowdStrike here. We typically want to identify a bullish entry. Okay, a bullish entry could be a support bounce, could be a close above the high of the low day. It could be a bounce off a moving average or some other area that's identified as support. Or it could be a breakout of resistance, or a breakout of some sort of pattern, flag pattern, triangle pattern. Okay, those are the most key ones that some people might look for. I'm also going to say some people might look at it if the stock's at support. Maybe it hasn't given a full bounce at support, but people are like, oh, good, it's near support. I'm expecting a bounce and looking to get in. Now, CrowdStrike that we're looking at here, obviously a stock in an uptrend. What has it done just recently? Well, you can see I drew in this white diagonal line, and it looks like today it's bouncing off that diagonal support line. It's not a co-hold. It would have to go a lot higher to be close above the high of whatever our low day was. But in this case, we're going to take it as a bounce that might be a bullish signal that some traders might like. Okay, let's go to the trade tab here. And I'm going to change a couple of things. And I'm going to collapse our site here for a minute because I want you to see a little bit more in the middle. We're going to use the June 20 options today. Those have about 36 days before they expire. They're a monthly expiration, so they should have a lot of liquidity. And this stock's traded over 33 million today, so we're not likely to run into problems with liquidity here. Now, what I pulled up here is a chart, or not a chart, a column structure that is one of the defaults that they give us. All right, last price and net change. Okay, these are sitting here. We're going to modify that, and we're going to create our own column structure that we're going to use here today. So select on that last price and net change, and come down here and say customize column sets. Okay, this is going to give us the opportunity to put whatever columns we want to see. So the first one we're going to throw over here, we're going to grab the delta. We're going to grab, I'm going to type in probability, and we're going to grab the probability of expiring in the money, out of the money, and probability of touching. Okay, and I'm going to get rid of the last price and the net change, and we're just going to go with those 4 columns right now. If you like that, maybe you don't have a set of that. I will, I've got to change my ticker symbol there, which I'll do in just a moment, but we're getting kind of our structure here right now. If you wanted to save it, you could. And I actually like saving it with the definition that it pulls up, because it just shows you what were those columns that you selected. I like to save it under that name because then I know exactly what I'm getting into. So I'm going to hit save. If you wanted to, you could do that as well. And then I'm going to say, okay, get out of Walmart here. We're going to come back to CrowdStrike. All right, here we go. Now we're going to focus on something here for just a moment. Let's look at stocks at 430. So let's look at the 430 strike price for just a moment. And as we look at these columns, we'd see, okay, it's got a 55 delta, which is, it's our at the money option. So, you know, a 45 to 55 delta is pretty common. This first column, what's the likelihood of this stock expiring in the money is about 48%. Out of the money is about a 51%. And if you have the two together, what does that make? About 100%. Okay. So it'll break that up for you, and you see a more specific number of probabilities to expire in and out of the money. And then we have this column called probability of touching. And probability of touching is solely what's the likelihood that the price of the stock is going to go in that area towards that strike. And the number sometimes is higher than our probability of expiring out of the money, or sometimes it's lower. Now, for what we're going to look at here, we are going to use our delta here. We'll go with this 32 delta. We'll come over here. This is the 470 strike. And I'm just going to highlight it here for just a moment. And, oh, oops, I grabbed a couple of them. So we're going to use that bottom one, the 470, okay? If we were to sell the 470, the probability that it could expire out of the money is going to be about 73%. Okay. What's the probability of touching the strike price? Well, it's about 53%. So there's a probability, almost like a 2-in-1 probability, or I should say 1-in-2 probability, that the price of the stock is going to go there. Now look at the 460 here. On the 460, the probability that it would expire out of the money is about 68%, but the probability of touching is about 64%. So it may not necessarily mean that it's going to expire in the money, even though it's gone and touched the short strike price. Now, if we were to look at, say, we'll go another strike price here. Let's focus on the 450. See if I can draw a good box here. On the 450, suppose somebody wanted to sell something with a little higher delta to bring in a little higher premium. Certainly people can approach it that way. And the probability of it expiring out of the money is going to be about 63%, which is higher probability. But there's a 75% chance that that option would touch, okay, that price of the stock might touch 450. And now this is looking at, say, maybe a short call vertical. We're going to focus on some short put verticals. But the idea here is, you know, when you get into the trade, there's a 3 out of 4% chance the price of the stock's going to go and touch that 450, but there's a much lower probability that it's going to stay there and expire there. Okay, so even though it might go there, if you know, oh, I knew at the beginning of the trade it was a 3 out of 4 chance that it would do that, that can kind of help calm the nerves a little bit. Okay, oh, I knew that. I knew that going into it. Now, as we're looking at, say, a short put vertical, because this is a bullish stock, let's see if the strike prices I was looking at still look appropriate here. I was looking at using the 400 strike right here. I'm going to just highlight all of those. It's a 29 delta. The probability of expiring in the money is about 34%, which is low. That's what we want when we sell an option. It's about a 65% chance that it'll expire out of the money, and a 67% chance, so a little bit higher, that it will go and touch it. Okay. As we look at each of our trades, we're going to just kind of glance over that probability of touching. And it can give you a little bit of a mental reassurance that, okay, it's probably going to go there. There's a 2 out of 3 chance that it's going to go and touch it. So don't freak out. Don't crash out. Don't become overly distressed. All right. Let's look at this. Chris says, the expected move is more than 56 points in 36 days. That's a lot of time for a short call vertical for you. It might be. You might not like to go out that far, Chris. In looking at the ones that we have available for us to use, one of the things I'll do is I'll kind of go out and look at the weeklies that maybe might be appropriate. Okay, so I'll come out here and look at the 22 days. I'll come out and look at the 29 days. And I'll just kind of look at open interest and volume. So let me change my column structures here. Let's go to this one. We'll grab that so that we can see the open interest, and it's just on the light side. Okay, we want to have a lot of contracts out there exchanging hands. And so I'll go and look at those, but if there's not enough open interest, I'm just going to go straight to the monthlies. I'm not going to be concerned about trying to sell less time. Okay, appreciate you bringing that up. Joe says, probabilities assume no unexpected events will disrupt the market, correct? It's assuming kind of in a vacuum. Okay, it's making a probability that the stock could go and move to that area, or that it's likely to expire out of the money or in the money. But things can happen, things that aren't expected, right? News can come out, the CEO could do something stupid, right? Things could happen that might throw that number off, or might cause the price of the stock to go in an area you were hoping it wouldn't really go to. All right, so we've looked at the probabilities here. Let's go ahead with our 400, 390. We're going to say sell vertical, and that's going to give us a credit of about 285. Now, this is a $10 widespread, all right? So let's do some numbers here, and I'm going to just kind of put a little space in there for us. 285 is our max theoretical gain. Our max theoretical loss then should be in the neighborhood of about, 615 should be our max loss. If we added those two numbers together, we should get $10, the amount of the spread. Now, what kind of a return would that give us? Let's go to our calculator here, and let's collapse our watch list for the moment. And let's just calculate it out, all right? 285 divided by, actually, I'm just going to add that together here, all right? I'm going to make sure I've got that right. 285 plus, let's clear that real quick, 2.85 plus 6.15. That's only $9. Okay, it needs to be 715. I was missing a buck. I'm glad I did that. All right. So we're going to say 285 divided by 715. Some of you might have been catching my math there. Thank you, NK. It looks like it's about a 39% return. Now, that's a pretty decent return. It's a healthy return that some people might be happy with. If somebody wanted to be less aggressive, they might sell a little further out of the money. They could see if maybe the 24 delta might give them what they're looking for as far as their minimum return. But several people might be comfortable with this. And for our purposes, yeah, we're going to go ahead and use it. Notice that the probability of expiring out of the money, again, is about 65%, and the touching was about 67%. All right. How many contracts could we do? Well, in this class, we don't want to risk more than about $1,500. Knowing that 715 is our max theoretical loss we want in any trade, then we could do two contracts here. Okay, so we're going to do our two contracts, and then we're going to do something that we typically do. We identify our stock. We see that it has an entry that people are comfortable with, right? What your rules will say is something you're comfortable with. And then we identify something that maybe gives us a return that we're content with. And then the last step is we're going to put in an exit order. Typically in this class, we'll put in an exit order to close out the trade if we get a chunk of the gain, all right? So we've got our first trigger sequential. I'm going to create an opposite order here. If we get a chunk of 285, we're going to be happy campers to get out early. All right. I've given the example that, some people are like, man, I want to just get every little last penny out of this spread, when maybe that might not be the best way to trade them. You might be in better shape to say, let me get out when I've got a chunk and just leave a few pennies on the table and not worry about it, because then sometimes you're risking a lot more to gain those 5 cents or 10 cents or whatever it happens to be. So in our case, 285 is our credit. If we get 70% of it, only 30% is left. And so we're going to say, hey, let's go buy back at 85 cents. We'll be happy with that amount of a gain. We're going to put this good till canceled. Now, a question comes up frequently, should we identify for a loss? Some people, because it's a hedge trade, some people don't like to put a stop loss on it. But mentally, maybe you do want to have something in mind, or some people will physically put it in. Something some traders consider is if the credit goes against, or if the spread or the value of the spread is maybe the opposite direction, like say minus 285, if the spread kind of gets to that point, then kind of 100% of what you were expecting to bring in, some people might draw a line in the sand there and say, it's not worth it to me, because now I'm risking as much as what I had to gain. And initially, I had put together a high probability trade. Okay, so we're not going to put in that exit, but we will put in this one to go buy the spread back. And I'm going to put this in our bullish bucket, bull short verticals. All right. Now let's do this. Priya says, there are earnings on June 3rd. And you're right, there are. That's one thing we do want to pay attention to, what those events are. Some people would say, I'm going to make sure I'm out before then. Could we hit a majority of our gain prior to June 6th? That's about 3 weeks out. I'm going to say, yeah, it is probable. Now let's talk a little bit about exiting the spread. We're going to head back to our slides here for just a moment. So we head over here. We talked about that. When should you consider getting out? Okay. Number one, 4 to 10 days before the option expired. That's kind of where you get to a point that you're like, my time is running short. I need to find an exit. Maybe you don't get out with as big of a gain as you thought, or maybe you decide to get out with a small loss because you don't want to get trapped in that trade. What happens as options expiration nears? Well, open interest dries up. People are closing out their positions. Okay. Then we can do what we put in an order to do, which is get out when we get a percentage of the max gain. If you do have a predetermined spot that is before maybe your max loss or at max loss, you could get out. However, if you're already sitting at a max loss and you have some time on the clock, some people might say, it's not going to get any worse. I'm already at my max loss. Let's see if maybe something changes. Now, something that we've done in this class quite a bit is if the stock makes a major break of resistance, or break in this case of support, right? Because we're looking at the stock going up. If it makes a major break of a significant support level, then we might consider getting out of the trade altogether, or doing something we've talked about in the past, which is basically flipping our trade, call a change of polarity, and we totally turn it into a bearish trade from the initial bullish trade that we had. Okay, if it does break a resistance level here, it could mean that the stock is starting to trend the opposite direction of where it was when we got into it. Okay, so keep these ideas in mind, and we'll talk about them as we are following. Now let's head back. Let's come over here to, I'm going to send us over here to, come up here. I'm going to take you over to something. There we go. This is what I wanted to show you. Why is it not coming to the front? Let's see here. Maybe if I just minimize that, it'll show up. I think it's not. Let's do something else. I'm going to open this. I see what the problem is. I left my marker on, and so it's just putting yellow dots on me. Okay, we don't need the yellow dots. Let's go. I apologize for this, you guys. And let's go to let's see if I minimize it now. And minimize that. And that. Oh, it's still not coming up. I want to take you over to our Trader Talks page. That's what I'm attempting to do here. And I'm just going to grab this new little tab and bring it over. And we're just going to go into our Trader Talks channel. The reason I want to bring you over here is because most of you have joined our 150,000 subscribers, but there are a few of you that haven't yet. But it makes it a lot easier to find our content if you come and be a subscriber. There's a little link in the bottom right of your screen that you can select on, and it'll subscribe you to our channel. On our channel, you can go over here and you can see the playlist. Suppose you weren't here 3 weeks ago when we had our class on building that watch list, and you're like, I kind of want to go back and review that. Come down, probably about 7 rows down, and you're going to come over here to short verticals. Ben Watson taught it for me last week while I was gone, so that's why Ben's happy picture is sitting here. But you can come over here and you can see all of the classes that we've had in the most recent period of time. And the one that it is here is the third one down. On the thumbnail, it says creating a watch list for all seasons. And the other kind of point in that particular session was salvaging a trade gone wrong on you. Okay, so that is the one that you're going to be looking for if you want to go back. Being a subscriber, man, it helps you find things a whole lot easier. All right, let's get back to our Thinkorswim. Let's pull up another one here. And let me grab, okay, we're going to do Walmart. Walmart technically was not on our list. I wanted to do it because of what we're seeing on the chart today and the fact that it had its earnings. And earnings is out of the way. And sometimes people are just looking for something that's done with earnings. Although we're kind of wrapping up the end of earnings season, right? Started in April. We're here through the middle of May. And so things are kind of drying up except for retailers. Now, as we come in, we see Walmart has been up a little bit and down a little bit here today. As you look at this candle, it's not a perfect hammer, but I'm going to call it hammer-like. A perfect hammer candle, we would see something like a small head, and then would see a shadow to the downside that is at least twice as long as the height of that head. Now, as we look at this candle, this head is not small. However, it could continue to move in a direction like it has, where it's up off its lows. And so therefore, I'm going to say it's hammer-like looking, even though it's not necessarily there. Some people might also like this for an entry because it looks like it's bouncing off that moving average, which is a 30-period moving average. All right. So knowing Walmart is out of the way, knowing that, quite honestly, it's looking a little bit more bullish, although initially the initial reaction was a little bit negative for Walmart, we're going to go off the idea that it is having the support bounce at the moving average. And so let's go into the trade tab here. I'm going to change my columns back. We're going to go to this one that we built here earlier, our probability of expiring out of the money and probability of touching. It's actually not the same one we built, but contains most of the same information. Okay. And as we look at Walmart, let's see what we might choose. Again, I looked in the weeklies. There's not a lot of open interest there. Let's go out. Let's look at, we could maybe look at a delta. Got about 28 or 41. You know, many times traders will like to find a 30-something delta or a 40 something delta or a high 20 something delta. The one I was looking to do here earlier, I was looking to do the 95, 92.50. Let's take a look at it. So we're going to go ahead, we're going to sell the vertical, I'm going to bring this up, and for ease of use, I'm going to round that to 80 cents here. And that is going to be our max gain. Now, this is a $2.50 wide spread. Okay, so not as big of a spread as the first one that was 10 bucks. So say 250 minus 0.80, that's going to give us our max theoretical loss. And so I'm just going to put that down here. I'm going to put 1.70 is the max loss, and our max gain here is about 80. We know all of that in advance. What kind of return might that give us? Well, if we take 80 cents and divide that by $1.70, that's about 47%. Now, some of you might say, well, gee, if it's 47%, maybe I can find it, maybe I'll go for a little bit further out of the money. And you certainly could go run those numbers and see if it meets your rules. Okay. This one is a little bit higher return, 47%. Some people are happy about that. There might be other people that are like, I'll take the trade-off of a lower probability of success, which if they went out would be like 69% instead of 56%. But look at this, the probability of touching. This is 88%. Now that one's significantly higher than the other one we looked at, right? That's telling us, man, there's like an 88% chance that Walmart's going to go to 95 before this option expires. Should we freak out about it? Should we have undue stress just because it goes to 95? And the answer is no, we already knew that. We already knew there was a high probability it would go in touch, but it doesn't necessarily mean that there's a high probability that that is where it's going to expire. Okay. And so that is the value of having that on your column to kind of reassure you as you get into the trade what the likelihood is. Now, the max loss here is going to be about $170. So if we are willing to risk $1,500, let's divide that by 170. That says we could do 8 contracts. So we're going to do it. And we have lots of open interest here, which is nice. We're going to be just a little tiny part of the balance of those contracts there. We're going to do a first trigger sequential. We're going to create an opposite order. And again, we're going to say, what's a big chunk? What's a big chunk of 80%? What if this time, what if we say 80%? And we want to go buy it back if it has 80% and leaves 20%. Okay, so we'll multiply that by 0.2, and that says go buy it back at 16 cents. We're going to plop our 16 cents in there. We're going to make it a good till canceled. And we're going to send this off. Market's open. We're expecting to get that immediately. We're going to put it in our bullish short verticals box. All right. Chris says, I'd like to see Walmart over 100 bucks by about Wednesday of next week to save my calendar spread. So you're in it for a totally different trade, aren't you? You've got a calendar spread going on. So you're right. It'd be to your advantage that you maybe see Walmart drop a little bit, getting closer to your 90 strike price. All right. Now, I want to spend just a moment of time on one that we're not going to have a chance to put the trade in, but I want you to see the technical setup here. Philip Morris. Philip Morris was on our watch list. Philip Morris is having what some would consider a bullish entry today. We've got a bounce off the moving average. We have a close above the high of the low day. The market's not closed yet, but it's looking like it's in pretty good shape to close higher than the high of the low day. This looks like this was the candle where the price was the lowest. Its high is about there, and yeah, it's clearly moving. So close above the high of the low day entry that some like, support bounce and so forth. Same thing. We're going to go over to the trade tab. We're going to come over to the puts. We're going to have our PM come across here. And I'm just going to queue it up. I'm going to put it in later. Okay. Here we're looking at about 165, 62% chance that it would expire out of the money at this moment. That changes as the trade evolves. But what's the probability of it touching? It's about 74%, a 3 out of 4 chance that the price of the stock is going to go to 165, even though it's not likely to expire there. Take a step back, breathe normal. Okay, it's going to be all right. I'll go ahead. I'm going to put in the 165, 160. After our class is over, I'll position size it to how many contracts we can have in our class. I do want to follow up on a couple of trades that went in when we met last. Okay, first one is going to be PanW. Now, PanW, technical or an IT stock, we got in right here on April 24th. We were getting in on a breakout above resistance. That breakout, man, that stock continued to run. And we put in an order to get out if we got a chunk of our gain, which we did, okay? And so automatically, I was off on my trip, goofing off, having a good time, and Thinkorswim went ahead and captured that gain for us, okay? So that particular one turned out to be after we brought in our credit, bought it back for a little bit of money, which was, if we go to account statement here to PanW, was about 35%, okay? We brought in initially $1.50 credit on it. We went and bought it back for 25 cents. That's where we get our 35% return, okay? Taking the net on this, $1.25, dividing it by our theoretical max loss, 75. The other one that was very similar is Zscaler. Now on Zscaler, we put it in the same day. It had a little bit a breaking movement here. We got in on the May 1st. Now I take it back. We got on here on the green oval, the 24th of April. Same thing, breakout entry, continued to run. Got us out on May 1st because we had our orders sitting out there. Don't have to watch it. You can be out walking your dog. You can be doing whatever you want to do. And you put that order in that says, go nab it. If I get profits on that and I get a majority, let's nab it and be on our merry way. All right. Today we're going to put in 3 trades. We analyze probability of touching and comparing that to probability of expiring out of the money and knowing that there's probably a high probability that the price of the stock's going to go where your short leg is, but it's not necessarily room to panic. It's not necessarily something you need to stress out about. Okay. Just know, guess what? It's probably likely to happen. And if it happens earlier in the trade, so be it. If it happens later in the trade, you might have to make a decision. If you need to get out, maybe you're in that short-term window, 4 to 10 days before the option expires. Yeah, you might have to decide to get out of the trade early by looking at a predetermined point when you need to be out of the trade. All right. So I hope that'll help you. I would like you to practice using that column. And as you're doing your paper trading, trying to get really skilled at this strategy, because it's a bread and butter strategy for a lot of traders, as you're practicing it, put that into your analysis and see if that kind of helps you as you're trading to not get overly excited if the stock goes near your short leg. All right. Brent, thank you for helping me out in the chat. I understand you're being the marathon man with the chats. I appreciate your helping us out and answering questions. I don't see a survey out here today, so you're off the hook for that. But if you did find this useful and helpful, go ahead and like the thumbs up button there. That'll let others know that you found it useful. It'll allow them to find the class as well as it moves the webcast up in the algorithm that YouTube uses. All right. Now, coming up next is going to be getting started with stock investing. If you're somebody maybe a little bit newer to the markets, the principles taught in that course and with Kevin Horner are so essential. They help you with your options trading as well. So that's going to be up next right at the top of the hour. And so if you're ready for that class, we'll see you back there in a half, well, at the top of the hour, I'll say in about 15 minutes. All right. Thanks, everyone. Have a great afternoon. We'll check these trades out in next week and see how they're doing. We'll see you then. Bye-bye.